Welcome back. We need to have a serious conversation about what's happening right now in global markets. While everyone's been watching silver climb to record highs, something far more significant and potentially devastating has been unfolding in Japan. And most Americans have no idea it's coming for their portfolios. Right now, Japanese government bond yields are spiking to levels not seen in over 3 decades. The 40-year bond just crossed 4%. If you're in Dallas or Denver, you might be thinking, so what? That's still lower than US rates. But here's what you need to understand. Japan has spent the last 30 years with interest rates pinned at zero. Their entire economy, the world's third largest, has been built on free money. A move to 4% isn't just unusual. For Japan, it's a 5-alarm fire. Here's why this matters to you, the American investor. Japan owns more than $1 trillion of US government debt. Japanese institutions hold hundreds of billions in US stocks. Apple, Microsoft, Nvidia, probably the same tech stocks sitting in your 401k right now. For decades, they've been the steady hand buying American assets because they couldn't get returns at home. That era just ended. With Japanese bonds now yielding 4%, the calculus has completely flipped. Why would a Japanese pension fund accept currency risk and market volatility to hold US stocks when they can get solid returns at home in their own currency with no exchange rate risk? They wouldn't, and they won't. We're looking at what could be the largest capital repatriation event in modern financial history. Analysts estimate Japanese institutions may liquidate approximately $500 billion in US equities over the next 12 to 24 months. To put that in perspective, that's equivalent to the entire market cap of Tesla being sold into the market. But this isn't retail investors panic selling. This is the world's largest pension fund, the Government Pension Investment Fund of Japan, methodically unwinding positions to cover losses at home. Here's what makes this different from every other sell-off you've experienced. This is forced selling. When Japanese bond prices collapse, remember, when yields rise, prices fall, these institutions have holes in their balance sheets. They have retirees to pay every month. They don't have a choice. They must sell their profitable positions, which happen to be US stocks. This will be slow and relentless. Forget the flash crash scenario where everything drops 20% in a day. Panic ensues, and then buyers step in. This will be a slow grind. Down 2%, up 1%, down 2%, up 1%, over months or even years. Every time the S&P 500 tries to rally, Japanese selling will cap the gains. It creates a feedback loop. Here's where it gets really dangerous. When Japanese funds sell US stocks, they receive dollars, but they need yen to pay pensioners in Tokyo, so they sell dollars and buy yen. This strengthens the yen, which blows up the carry trade, where hedge funds borrowed yen at 0% to buy US assets. Now those hedge funds have to unwind, selling even more US stocks. It's a self-reinforcing cycle of liquidation. But the stock market is only part of the story. The real catastrophe is brewing in US treasuries. Japan is the largest foreign holder of US government debt. They've been our most reliable customer, financing our deficits, our stimulus programs, everything. But with yields at home now competitive, they have zero incentive to keep buying. In fact, they may start selling. Think about what happens next. The US government needs to issue roughly $2 trillion in new debt this year just to cover our deficit. In normal times, foreign central banks, Japan, China, Saudi Arabia, would buy it. But look at the roster now. Russia sold everything. They're out. China is actively selling treasuries to buy gold and commodities. Saudi Arabia is diversifying away from dollar assets. Japan was the last man standing. Now they're heading for the exit. When there are more sellers than buyers in the bond market, prices crash and yields spike. If Japan dumps even a portion of their $1 trillion treasury holdings, we could see the 10-year yield jump to 6% or higher almost overnight. This is where it gets really interesting and really inflationary. At 6% yields, the American economy stops functioning. Mortgage rates would hit 10%, the housing market would freeze, corporate debt becomes unserviceable, bankruptcies would cascade through the economy. More importantly, the US government itself would face a crisis. We're already spending over $1 trillion annually just on interest payments, more than we spend on defense. If rates double because Japan walks away, those payments jump to $2 trillion. We'd be mathematically insolvent. So what's the Federal Reserve going to do? They have exactly two options: let yields spike and watch the economy collapse into depression, or print trillions of dollars to buy the bonds Japan is selling. In an election cycle, with a debt-based economy, what do you think they'll choose? They'll print. They always print. The Fed will restart the money printer. They'll call it market stabilization or liquidity support instead of quantitative easing, but the mechanics are identical. They'll create trillions of new dollars from nothing and use them to absorb the bonds Japan is dumping. This is the wealth transfer mechanism. Let me break it down. Your stocks are at risk. If you're holding the same tech stocks that Japanese institutions are systematically selling, you're providing their exit liquidity. You're buying what the smart money is selling. Your bonds are at risk. Rising yields mean falling bond prices. The safe part of your 60-40 portfolio isn't safe anymore. Your cash is at risk. When the Fed prints trillions to monetize the debt, every dollar in your savings account gets diluted. Your purchasing power evaporates. Even money market funds, supposedly cash equivalent, hold short-term government debt. If the bond market breaks, these funds could break the buck like they did in 2008. This is why we're seeing an historic surge in precious metals. Silver just hit $94. Gold is approaching $4,600. This isn't random speculation. The smart money sees exactly what's coming out of Japan. They understand that the only solution to a sovereign debt crisis is currency debasement. When the Fed creates $3 trillion to buy Japan's bonds, they're effectively transferring wealth from dollar holders to hard asset holders. It's not magic, it's accounting. Gold and silver are the only financial assets that aren't someone else's liability. They have no counterparty risk. If Japan goes bankrupt, your silver doesn't care. If the US Treasury has a debt crisis, your gold doesn't care. And while gold is the shield that protects wealth, silver is the sword. The silver market is smaller and industrial demand is inelastic. When institutional money flows in, the price moves fast. In the 1970s inflationary crisis, in the 2011 debt ceiling crisis, and now again, silver outperforms during monetary chaos. Here's what you need to understand. We're not in a normal market cycle anymore. The strategies that worked for 15 years, buy the dip, hold stocks long-term, keep 40% in bonds, were built for an era of falling interest rates and expanding global liquidity. That era is over. The Japan crisis has flipped the script. We're entering a period where sovereign debt becomes a liability, not an asset. Paper assets face structural selling pressure. Hard assets become the only real store of value. The timeline is critical. This won't be a one-day crash, it will be a grinding 12-24-month liquidation event. There will be rallies that make you think it's over. The media will tell you Japan is fixed. They're wrong. The math is terminal. A country with 260% debt to GDP cannot survive at 4% interest rates. Position yourself now. By the time this hits mainstream news, the best opportunities will be gone. When CNBC is talking about the Japanese debt crisis 24/7, silver will already be at $150 and the exit door will be jammed. Here's the framework. Exit the danger zones. Overvalued tech stocks facing Japanese institutional selling. Long-duration bonds getting crushed by rising yields. Anything dependent on continued cheap money. Move to safety. Physical precious metals, with emphasis on silver for leverage to the currency crisis. Energy producers and resource companies. Real assets with tangible value. Be patient. This is a marathon, not a sprint. The slow grind will test your conviction. Stay focused on the fundamentals. Unsustainable debt plus rising rates plus Fed monetization equals currency debasement equals higher precious metals prices. Japan's bond market isn't just cracking, it's shattering. The yields tell the story. The capital flows confirm it. The Fed's response is predictable. This is the largest wealth transfer in modern history, moving from paper assets to physical assets, from the financial economy to the real economy, from those who trust central banks to those who understand monetary history. You have the information. You understand the mechanism. The only question is, what are you going to do about it? The water is heating up. Don't be the last one to notice it's boiling. Stay informed, stay positioned, and stay ahead of the curve. We'll see you on the other side.